We're continuing with chapter 1. Once we have established the framework of how corporations look like, let's now delve into what's the goal of the corporation and how does the person who manages that corporation, what is their goal going to be? So when we look at a firm, at a financial manager that is managing the corporation, they have three major decisions that they have to make. They have to make decisions about investment. Where do they invest the money that the corporation has? How do they finance their investments? So they want to acquire or invest in a building, or they want to invest in a new factory, or they want to invest in some new technology. Well, that's all well and good. They have to make a decision on that. How do you know that investing in this particular building is a good idea? How do you know investing in this particular technology is a good idea? So that's a decision. Once they have made the decision, then they have to ask the question, well, how do I pay for it? How do I pay for the investment decision that I just made? And then once that financing decision has been made, and there are basically two different choices, either equity or debt. Use either stock markets to raise capital or bond markets to raise capital. And we'll talk about the differences between stock market and bond market later in the course. Once you have now raised capital, you have invested that capital, now you are making money. Well, how do you manage that cash flow from the operation of the firm? What do you do with that money? Where do you reinvest at? How do you manage that investment? So all financial decision making can be broken into these component parts. How do you make an investment decision? How do you make financing decisions? And how do you manage the cash flow that you generate from decision 1 and decision 2? So just like anything else in life, we have to weigh between costs and benefits. But what we have to think about in finance, it is not a simple calculation about cost and benefits alone, because the costs and benefits may be incurred at different times. So for example, you could have a situation where you invest some money today. Let's call that investment I, or I0, indicating it is being invested at time 1, but cash flows are received at time 1 and at time 2. So C1 and C2 represents benefits. They are positive cash flows. Thus, we represent them with upward arrow. I0 is a negative cash flow. I paid money, so I represent that with a down arrow. So these are my benefits, and this is my cost. So I have to make a decision. Do the benefits outweigh the cost? But the challenge comes from the fact that they are incurred at 3 different time periods. The investments are made today, benefits are generated later in time. That complicates the analysis, and we'll learn about that later. Financing decisions, we have to ask the question, should we sell more shares and thus use the stock market, or i.e. use equity, or we should borrow the money, i.e. use debt. So it's equity versus debt, or debt versus equity. When do we use debt to finance our decisions, our investments, and when do we use equity to finance our investments and our decisions? And then how do we manage short-term cash? How do we manage what we call working capital, something that we will learn later in the course. So what's the goal? In doing all of these 3 things, you have an investment decision, plus a financing decision, plus a working capital decision. But what is the overriding goal in managing these 3 things? And the overriding goal is that the goal of the manager should be to maximize the wealth of the stockholders. There are 3 key words over here that I have double underlined. Number 1, maximize. Number 2, wealth. And number 3, stockholders. So let's take them one at a time. What does the word maximize imply? The word maximize implies that we are not simply increasing the wealth. We have to maximize the wealth. Implicit within the word maximize is that we have to increase our wealth subject to the constraints of risk. It is not unconstrained maximization. Because if it is unconstrained maximization, we can take the money from our stockholders or bondholders and go to Vegas and gamble with that money. If you are lucky, we hit the jackpot. But why don't we allow companies to raise capital and do speculative activities like gamble on the Vegas Strip? The reason we don't do that is because that would not be considered maximization. Because going into that deal, you know that the risks from gambling outweigh the benefits from gambling. Right? The risks from gambling outweigh the benefit. That's the only reason, if you are running a casino, it's almost impossible to lose money. Why? Because the house always wins in a gambling deal. So when we talk about maximization, we are not talking about simply increasing profits. We are talking about maximizing profits, meaning you are making investment choices by not just looking at how much money you will make, but you are also asking the question, what is the risk from this activity? How much do I put my capital at risk? That's also an important question to ask. The second word in this objective statement is the word wealth. Notice what it does not say. It did not say profits. It did not say earnings. It did not say income. It said wealth. Implicit within the word wealth is a long-term view of capital. That means I'm not just looking at what will be my profits in year one, but I'm looking at what happens in year two and ... beyond. I'm looking at the whole game. I'm taking a broad view of everything. Second, implicit in that word wealth is that we are not talking about profits or earnings, which are simply a statement that we see on a piece of paper based on accounting rules, which is something we will learn about later. When we learn about accounting rules, we will see how does wealth differ from cash. Wealth or cash differ from profits. So when we talk about wealth, implicit within that, we are looking at cash. We are looking at value, not profit, which is simply an artifact on a piece of paper. Third is the word stockholders. We are not increasing the wealth of employees or managers. Our objective is to increase the wealth of stockholders who are also regarded as the owners of the corporation. They own the corporation. And it is the wealth of the owners that we are tasked with increasing. There are some moral issues, ethical issues that comes into play when we take a deeper dive into this objective statement. Particularly the question is, why owners? Why not everybody else? There is a plausible answer that explains why this is a perfectly defensible objective. And the plausible answer is that this goal is going to be attained, owners' wealth are going to be maximized only if the obligation of the rest of the corporation is met. We will see this more vividly when we learn about the income statement of a corporation. In brief, the income statement looks like this. You start with sales, you subtract cost of goods sold, you subtract depreciation. That gives you EBIT, earnings before interest and taxes. We subtract interest. That gives you earnings before taxes. You pay your taxes, and that gives you net income. That gives you net income or earnings. So the idea is that if I can maximize this bottom line, I can only maximize this bottom line if I've satisfied all of these other obligations. I have paid the costs that I need to pay to my suppliers. I have paid interest. I've satisfied my debt holders. I've paid taxes. I've satisfied my government. I have paid other expenses, which are employee costs, salaries, and other things. I have paid my utilities. All of those other things have been satisfied before I can talk about earnings that belongs to the owners or earnings that belong to the shareholders. So if I'm maximizing this earnings, by definition, I have met all of the obligations that preceded that bottom line. And thus this statement becomes a perfectly defensible objective to attain. But when we look at a modern-day corporation, one of the artifacts that we also see is what we call the separation of ownership and control. Who controls the corporation? Managers. Who owns the corporations? Stockholders. And they are not necessarily the same person. So the owners, through the board of directors, hires the CEO that is tasked with managing the corporation. And that creates both a benefit, that benefit number one, you're getting a specialist to help you run the corporation, but it also creates challenges because the goals and objective of the manager may not align with the goals and objective of the stockholders. And that has its own challenges to manage. But typically, this is how a corporate structure is put together. The shareholders elect the board of directors. The board of directors hires the CEO. The CEO is then the person who hires the rest of the management team, and the rest of the management team goes out and hires the rest of the employees. A typical organization chart in a corporation. You start with the board, the CEO, they hire the two top officers, and then the rest of the aspects of it. So when we are talking about finance, this is what we are most interested in right now. We are talking about the treasury functions, and we are talking about controllership functions. But what we are mostly interested in finance is on this side. The controllership type of activities are of more interest to accountants. We are talking mostly about capital budgeting, risk management, credit management, cash flow management, and so on and so forth. Because of this separation between ownership and control, stockholders being different than the managers of the corporation, because of that, it creates what we call an agency problem. This particularly happens when managers put their self-interest ahead of the interest of the shareholders. And to mitigate those agency problem, the corporation has to incur agency costs. One type of agency cost would be performance monitoring. So you have performance evaluation on a periodic basis, and that creates a cost. And that's the way the corporation manages this possibility that the interest of the manager may not align with the interest of the shareholders. So we evaluate performance, and incentives are provided for additional performance. One of the incentives is that the CEO is also made part owner of the corporation by being awarded some shares in the corporation. Here is a look at the stock market, which is where the shares of the corporations trade, and we will learn more about what we call primary trade versus secondary trade. But the largest stock market in the world now is NASDAQ, followed by NYSE, if I particularly add up the European sector and the US sector of NYSE. Those two would make up the largest, both of them US based, and the largest two foreign groups that we have are London and Tokyo, and then the rest of it. You can see that the staggering volume of shares or value of shares that are traded, this is the total value of shares traded in billions, ranked by their volume of shares. So you can see that this is 25, on an annual basis, the scale, this is 25,000 in billions. So it's $2.5 trillion being traded in the value of all the corporate, all the shares that are being traded in that market. There are two types of markets. A primary market where the shares are first sold by the corporation to shareholders, and then secondary market. Secondary market is when the shareholders receive the shares, they can trade with each other with those shares. And we will learn more about this, the different types of share markets that we have, the auction market, the specialist market, and what we call the bid and ask spread. But I want to take a little bit of a time and show you some quick examples of the different types of markets that we have. So if I look at over here, I'm looking at the NASDAQ market. This is the one of the largest market. You can see, how this is today's market, how the share price, this is the aggregate shares on NASDAQ, how the share changed value over time. This is the New York stock market. And over here, we can also see the aggregate data of the different major stocks that traded on New York today. These are the biggest movers in the market today. We can track it through the indices, the NYSE Composite Index, Dow Jones or S&P 500. Here is a picture of Dow Jones as it changed value from 1985 to today. You can see in 1985, on February 1, 1980, or on March 1, let's see, on March 1, 1985, Dow Jones had a value of 1,266. Today, that value is at 18,279. Quite a staggering jump in the value of the Dow Jones Industrial Average. What does that mean? What does that rise in capital actually mean for us? We will learn more about that when we get into the stock pricing chapters later. Okay, again, we will learn more about the listing standards and how does a stock get listed on, how does a stock get listed on NYSE versus how does it on NYSE versus how does it get listed on NASDAQ. The next thing I want to briefly talk about is the bid-ask spread. The bid-ask spread is the difference in the price at which the market buys the stock and the price at which they sell the stock. And the price at which they sell, which is the ask, is greater than the price at which they buy, which is the bid. And the difference between the ask and the bid is called the spread. And the spread is essentially the transaction cost of the trade, one of the transaction costs of the trade. The spread is also the profit that the market makes from buying and selling shares to keep them in business. There are other types of financial institutions other than the stock market. Financial institutions that help corporations raise capital and market those capital and manage capital. So if you are an investor if you are a business person who has extra capital, how do you invest that capital? How do you put that capital to good use? We manage them through financial intermediaries. So what the financial intermediaries do is they bring savers and investors in contact with companies and projects. So we have what we call the surplus units, people who have more money, like households. At the end of a period, the household may have saved up some money. They would be surplus units. And then we have deficit units, like corporations, which are looking for capital to make new investments. And the role of a financial institution is to manage this flow of money, get money from savers to corporations, and then get money back from corporations to the savers. And that cycle comes not only through profits and interests, through dividends and interest, but also through wages. And that's the financial cycle. A good financial market would manage this whole process in a way that is transparent, that is efficient, and that is fair. And it has always not been that way. In the well over 100 years of modern financial market, we have had several ups and downs. We went from an institutional structure that was very dense and very opaque, not well known to people, to an institutional structure today that is fairly well known, fairly transparent, but importantly, not without problems. And we will learn some of that as we proceed through the course. So that when we talk about the financial market, we're not just talking about the stock market. We're not just talking about the bond market. We're also talking about banks, about insurance companies, about mutual funds, about pension funds, hedge funds, venture capitalists, private equity funds, and so on and so forth. Literally trillions of dollars in transactions happening on an annual basis all around the globe. Because today, the financial markets are not just national markets, they are also global markets. And how they're all linked up to each other. It creates tremendous opportunity, tremendous employment opportunity, tremendous career opportunity, and tremendous opportunity to grow businesses. Today, a businessman can literally borrow money or access capital from anywhere on the globe. An American businessman is not limited to raising money only within its geographical borders. It does certainly creates opportunities, but it also creates costs, and most importantly, it creates different types of risks. So here is, again, a quick recap of the different types of financial institutions that we have. What is their source of money, and how do they use money? It'll be a very good exercise for you to review this, and if you have any questions about it, certainly ask me either by email or in person. So the role of a financial institution is to move money from the savers to the borrowers, allocate money through time, what we call intertemporal management of capital, and very importantly, manage the risk that this capital is under. And this completes chapter 1.